It seems that everyone is concerned about the current state of the economy, and rightfully so. The consequences of high inflation and rising interest rates are already being felt in the economy. Companies are scaling back on hiring, and people are cutting back on non-essential spending. Individuals are growing increasingly anxious about how they should invest during an economic downturn. Seeking guidance, it makes sense to turn to renowned investor Warren Buffett, who, at the ripe age of 92, has weathered 18 recessions throughout his lifetime.
All of these economists with 160 IQs that spend their life studying it, can you name me one super wealthy economist that's ever made money out of securities? You know, I mean, just go down the list.
No.
No, Keynes actually, in his early years, tried to make money in stocks by predicting what business would do, and he gave it up. And then he went over to a Graham-type approach. I mean, it's very interesting to read his history on this, because he thought he could, by looking at various economic variables, pick what he called the credit cycle and make a lot of money. And he went broke a couple of times in doing it, had to borrow from people. And then he settled on buying good businesses cheap that he understood and concentrating his investments. And he did very well. It's an interesting history. But if you look at the whole history of them, you know, they don't make a lot of money buying and selling stocks, but people who buy and sell stocks listen to them, which is, I have a little trouble with that.
Warren Buffett's advice challenges traditional investment wisdom. One doesn't amass such immense wealth and success by blindly following conventional strategies. Most people's investment approach typically involves predicting the economic landscape for the next 12 to 18 months, basing their investment decisions on those predictions. If they anticipate a robust economy, they buy stocks, and if they expect a downturn or recession, they sell their holdings. This generalized description may oversimplify matters, but it aligns quite closely with reality. Simply tune into a business news program or open up YouTube, and you'll be bombarded with this type of advice. However, this strategy of making investment decisions based on economic predictions is fundamentally flawed, and there are two significant reasons why following it will likely lead to financial losses. According to Buffett himself, for any information to factor into your investment decisions, it must pass a simple two-step test. Firstly, the information must be important and, secondly, it must be knowable or predictable with a reasonable degree of accuracy. Economic predictions undeniably meet the importance criterion. Understanding the future state of the economy would greatly benefit investors. If you could accurately time the entry and exit points of home building and auto stocks, for instance, you could sell just before a deep recession hits and people stop purchasing houses and cars. Conversely, you could buy these stocks right before the economy rebounds, reaping substantial profits. Soon enough, you'd find yourself a billionaire and a legendary investor.
Charlie and I haven't the faintest idea where the stock market is going to go next week, next month, or next year. We never talk about it. You know, it never comes up. Our directors will tell you that they've never been to a directors meeting where the subject of the direction of the stock market is. We are not in that business. We don't know how to be in that business. Obviously, if we could guess successfully a high percentage of the time where the stock market was going to go, we would do nothing but play the S&P futures market, where there wouldn't be any reason to look at businesses and stocks. So it's just not our game.
However, economic predictions fail to meet the second criterion, that of being knowable. Even at nearly 100 years old, Buffett himself has never encountered someone who can consistently and accurately predict the economy. The economy's inherent complexity renders it nearly impossible to predict. While some perceive the economy as a simple equation like x plus y equals z, it operates more like a complex calculus problem with countless variables, all interconnected and impact one another. As economies become increasingly globalized and intertwined, events in one country can influence the world. This complexity renders economic predictions unknowable and, consequently, unreliable. Usually, when economic prospects are brightest, stocks are the most expensive. If one insists on owning stocks during favorable economic conditions, they'll end up paying a premium for their investments. The more expensive the stocks at the time of purchase, the lower the future returns, and vice versa. When economic sentiment turns negative and concerns about the economy arise, people tend to sell their stocks, resulting in lower stock prices.
We're a net buyer of stocks over time, and just like being a net buyer of food, I expect to buy food the rest of my life, and I hope that food goes down in price tomorrow. So when stocks are down, we're going to be buying on balance, and who wouldn't rather buy it, at a lower price than a higher price? People are really strange on that. I mean, because most people, most of your listeners are savers, and that means there'll be net buyers, and they should want the stock market to go down. They should want to buy at a lower price. But they have that feeling that they just feel better when stocks are going up.
Legendary investor Howard Marks provides a diagram that perfectly illustrates this market behavior. The chart portrays investors' emotions, depicted as dots, over time, as the stock market moves in the background. As optimism builds, stock prices rise in tandem, eventually reaching a peak where euphoria sets in. Interestingly, this peak represents the most expensive point for stocks and the moment of maximum financial risk. To quote Warren Buffett, "You pay a very high price in the stock market for a cheery consensus." At this stage, the economy and stock market invariably start to turn, prompting a shift in investor sentiment. Denial turns to anxiety, then fear, and continues down into panic, depression, and eventually capitulation, indicating investors' complete abandonment of the stock market. The extreme of negativity is despondency, reflecting the greatest uncertainty and worry about the future outlook. Curiously, this is precisely when stock prices are at their lowest, presenting an opportune moment to buy stocks and seize the ultimate buying opportunity. As conditions improve, investor sentiment transitions from skepticism to hope, relief, and eventually back to optimism, marking the start of a stock market recovery. It's worth noting that the first and last dots in the diagram both indicate optimism, as the cycle repeats itself.
You know, I've not earned any stars for my past economic predictions, and the good thing about my economic predictions, if I even do make them, is that I pay no attention to them myself. So, I really and the way we pick our investments is we just don't get into the macro factors. I can't recall a time when Charlie and I have looked at a business, either buying it in its entirety or buying pieces of it through the stock market. I just macro conclusions are just never enter into the discussion. I mean, you know, I'll pick up the phone. We've had these two in recent months, and I'll tell Charlie about it. And you know, we talk about a few things, but we don't talk about anything remotely macro, and that's really the way it'll stay.
This brings us to a critical question. If economic predictions aren't reliable for making investment decisions, what should investors do instead? According to Warren Buffett's strategies, 3 key principles are identified. The first is to focus on microeconomics rather than macroeconomics. While macroeconomics examines the broader economy, microeconomics delves into the specifics of a particular industry. By analyzing microeconomic factors, such as a company's market share, key players in the industry, and pricing power, investors can make more informed investment choices. These questions are crucial for determining the long-term success of an investment and are far more predictable than broader economic trends. The second principle is to adopt a strategy called dollar-cost averaging. This approach involves investing a fixed amount of money at regular intervals, regardless of economic conditions. The idea is to disregard whether stocks are cheap or expensive, instead consistently allocating a predetermined sum each month into the stock market. This strategy aligns with the advice of renowned investor Jack Bogle, who suggests dollar-cost averaging and turning a blind eye to economic and market fluctuations until retirement, when you can assess your account balance. Lastly, having a long-term investment horizon is crucial. Short-term stock prices are heavily influenced by prevailing economic sentiments over the next 6, 12, or 18 months. However, in the long run, stock prices are ultimately determined by a company's underlying fundamentals. And a stock's value is intrinsically tied to the amount of cash flow it can generate. Cash flow is king. When people grow anxious about the economy in the short term, it presents an excellent buying opportunity for long-term investors. Remember, the more worried people are, the better the chance to capitalize on potential gains. Adopting a microeconomic approach, employing dollar-cost averaging, and maintaining a long-term investment horizon can yield better results. By adhering to these principles and avoiding the pitfalls of economic speculation, investors can position themselves for success in the ever-changing world of finance. We appreciate your watching. Please hit the like button below if this video helped you in any way, and don't forget to subscribe to the channel. Thanks again, and see you next time.